You are live. Well, hello there. Welcome to another live episode of Be the Boss of Your Money. You're watching a live episode because I like going live. I like live streaming. It's a podcast. Welcome. Welcome to Be the Boss of Your Money, the place where you turn to learn about personal finance, asset management. That sounds a little technical. Investing tips, business, and lots of other subjects that are related to those. We had a guest recently, Dana Mantilia, talk about ID theft and cyber crime and how we can keep ourselves secure. I've had guests involved with who are teachers and just educators about social media, like Beth Granger, and I've had people like Rob Basso, Michelle Blum, Frank Marizzi. I've had so many wonderful guests. I've got some guests coming up on Wednesday this week. Eric Okon, um, who's going to be a terrific guest. BLS. It's him and his brother own this luxury limo company, but they just do a lot of cool things. Really interesting guy. And I've had Adam Posner on from the podcast, Junaid Iqbal, just a lot of cool guys. Anyway, let me get back on track. Let's talk about today. Today it was like your first day where I really felt like it wasn't just a give back from a rally that was overdone, the rally was a little overcooked, so we had to back off a little bit. But today was the first day where it really felt like we're really giving back a lot more than what people expected. It really felt like the correction isn't over. I don't really feel like we had the crescendo 2 or 3 day sell off where people really questioned the longevity of the current rally we're in. The rally is still ongoing in terms of the S&P and the Dow. I'm not really sure if you'd say that for the NASDAQ. The NASDAQ is off about 11% from its recent high. The other averages are not too far behind. I'm not ready to say we're calling this bull market rally to end, but today was the first day where I felt like there was a little bit of panic. There was a little bit of concern, and there was some technical levels and individual stocks that we spoke about right here on Be the Boss of Your Money that just crashed through levels. In particular, Amazon. I said if it breaks below 3,000, I think that would spell trouble for the broader averages. And so far, it looks like that's what's happening, unfortunately. So we're going to talk about why was the stock market down today. And look, there are a lot of reasons why stocks go down. And every day, professionals, the talking heads, try to identify the reason. We all as humans, we like a reason behind anything that happens. Well, why did something go down? Because if you can understand it, you could do something about it. Well, I know why something went up or down, so now I can do something about it. Whether or not you actually do something about it, sometimes the best thing is to do nothing. So we're going to talk about that. If you're watching this right now in the live stream, welcome. I would love to answer your questions in the comments. If you're watching this in the replay, welcome to you as well. Go ahead and hit me up with any questions you may have. I would love to answer those. Also, I'll see the questions in the comments. So let's roll the quick intro. We're going to do a quick, I'm going to wrap everything up between the daily update with perspective and what happened today. These are the things that you should know about. It's going to be good. So stick around. We're going to roll the intro and then I'm going to get back into the share screen and we're going to go through this real fast. Okay, we're back. Let's do the share screen and give you the update that you need to get through this. All right, the day could have been a lot worse. The Dow is off over 800 points at its worst time of the day, worst point of the day, down 500 points, down less than 2%. I have to tell you, I don't really get overly concerned with a 1% drop in the Dow. 2%, though, definitely gets my attention. 3%, we've got a problem. So it was a tough day today, but I don't think it was like a disaster. It actually, Dow bounced more than 300 points off its low on the day. The S&P down about a little over 1%, nothing terrible. NASDAQ was barely off, just about flat. Russell 2000, that's a small cap index, that got pounded today, down over 3%. You don't really notice the Russell 2000 because it's smaller companies, many of which you probably either never heard of, or if you did hear about them, you probably wouldn't even know that they are publicly traded. And then the VIX, that's the green one, that would typically go up in a down day. You really want the VIX to be the red one and everything else to be the green one. But the fear gauge is up almost 8%. And that means professional money managers were really in a rush to hedge their portfolios, buy some protection for their portfolios. And that's basically what that tells you. So that means there's a lot of worry creeping into the market. Let's just move on. Okay, let's look at the FANG stocks. Facebook was off, but Apple was up 3%. It's a big day for Apple. It's a company that big. Amazon was up slightly. See here, you see Amazon at 2,960. About a week ago, I said what levels, because we've been dropping for like the last, 3 weeks now in the market. And what I've been saying is if the market keeps going, we have to start picking levels of the individual components in the S&P 500 to get an idea of where the selling could stop. But it doesn't look like it stopped. Yes, Amazon bounced a couple of dollars, $5.50, big deal. But it's under 3,000. And as long as it stays under 3,000, that's when you start to see a lot of people wonder, maybe I should sell Amazon too. Maybe I need to protect gains or lock in the gains that I've made. Netflix is up a little. Google was off 1.5%. Microsoft was up 1%. Overall, look, more up than down, but these stocks have been getting pounded the last couple of weeks. But I'm a little concerned about some of the levels. Microsoft, I'm looking at 200. Google, I'm looking at 1,400. Apple, if we see that thing below $100, that means people really start to worry and want to start locking in gains. Facebook is looking like that right now. Let's go on to the next screen, okay? Reopening stocks were a disaster today. Planet Fitness down over 2%. Cinemark Holdings was down. Listen, Cinemark Holdings is a movie theater company, and with worries about a resurgence of COVID-19 around the country, and it's happening in Europe, it's happening in England and France, it's happening in Spain, it's happening in Germany, it's happening everywhere. We're getting this resurgence, and we're really good, and now it's popping up again. Just in the weather's getting colder, so as predicted, when the weather gets colder, we can see a resurgence in the virus. And it's starting to happen, and that's really scaring the heck out of investors. And now, what does that mean? Does that mean we slam shut again? We stop going to restaurants again? We stop going to movie theaters again? So that just slams things shut. Marriott Hotels is down 6%. That stock has been getting pounded lately. Royal Caribbean down. American Airlines down 7%. UAL down. Delta, just a disaster down. Delta, look at that. Delta down almost 10%, UAL down almost 9%. This is a really tough day for the reopening contingent. It was not a great day for the work from home, stay at home stocks, which is why overall we had a more of a down day than a flattish or a balanced kind of day. And let's just take a look. This is the most important thing I look at every day. The sectors. These are the ETFs that represent the major sectors. We're almost getting through this, guys. So just stick with me for a second. We're going to talk about the downside today. But technology was up a little bit, up almost 1%. Good for tech. But everything else was down. But the bottom of the pack, okay, building materials, industrials, energy, financials got hit. Just a crappy day in the market. Yeah, did I say that out loud? Yes, I did. So this is what worries about the economy. So when you see the reopening stocks go down, economically sensitive stocks go down, like energy, financials, industrials, and building materials. Ooh, that's a mouthful. When you see these stocks go down, that is an indication that there's worries about the economy. And I'll tell you what's going on, okay? Very, very quickly. There's two big things going on, and both of these have their own undertones. The first big thing, and if we could fix this like literally tomorrow, you would see a major rally in all the major averages. It would just be the reopening trade would just surge. You'd probably see the Dow surge a lot. I mean, just more than a lot. We weren't too far from highs, believe it or not, all-time highs in the Dow. But the main thing is that the stimulus, the CARES Act, like $2.5 trillion. It came, it went. I said here when it first started, hey, if everybody could just pay attention to this work from home, give it the 8 weeks, everybody's getting paid $600 extra in addition to state unemployment benefits to stay home. We could really kick this thing. Unfortunately, it didn't work. We need another stimulus. Who's going to pay for it? Well, I call these stimulus packages the great grandchild stimulus packages, because that's who's going to be paying for these packages, the great grandchild of mine. Okay. I say that jokingly, but I'm kind of serious. Also, it's kind of sad, but we can keep doing this. We can keep floating debt as long as foreign buyers are willing to buy treasury securities. These are treasury securities, believe it or not, pay pretty high yields, as pathetically low as they are compared to the rest of the world. So that's one thing. We didn't get another stimulus. The Democrats came down from like 3 trillion to 2.2 trillion. Republicans came up to 1.5 trillion. So it's not far, but we need another stimulus, because once the stimulus ran through, the stock market was trading up on just only on hope of a stimulus. But things started to slow down. Companies like Walmart and industrial companies. I know Walmart's not an industrial company. I'm saying Walmart and other companies like industrial companies. They need to see stimulus, or else there's no hope of a rebound while we're worried about COVID. All right, so that's one thing. The undertone to that is the death of Ruth Bader Ginsburg, notorious RBG, a very sad loss. And but now that Congress is going to be fighting over the filling Ginsburg's seat on the bench, that's going to be a battle royale. So I don't expect any stimulus or anything else to come out over the next couple of weeks. Certainly not before the election, which is November 3rd. I can't believe it's here already. It's just incredible how fast time is going right now. The other thing is now the bank stocks got pounded. So what happened with bank stocks, and why was like JP Morgan just over 100 now, well under 100? There are certain rules and laws and regulations. I'm aware of them. FinCEN and suspicious activity reports, because of the business I'm in. And what happens is this: when there is suspicious activity, but money being wired around the world or coming into banks, if there's anything suspicious, it's supposed to be investigated and turned over to governmental authorities. And it looks like internal compliance departments of a few global banks, including Deutsche Bank, which is like the leader of this, HSBC, and also JP Morgan, they didn't do enough to stop fraud, to stop money laundering. And people always wonder, how do these dictators of Venezuela and North Korea, why do they always seem to get their hands on money? Well, now you know why. It's trillions of dollars that were laundered through the American banking system. Laundered meaning illicit money is somehow moved all over the place until it starts to look like legal money, legitimate money, and it gets out to these dictators. And unfortunately, these big banks have helped, whether they knew it or not, fund dictatorships and human rights violators, et cetera. It's a very big deal. It's just a huge deal. So banks are going to have hell to pay just when they're going through the worst of the worst with low interest rates as it is. See, banks, it's very difficult for banks to make money on all the deposits, trillions of deposits that they have. So they try to make up for it by originating loans. But now they're having trouble with that with the pandemic. And it's a really tough position to be a bank investor these days. But this makes it even worse. So NASDAQ is down about 11% from its peak. European spread of the COVID-19. No vaccine in sight. Even optimistic companies like Moderna have come out and said they don't expect like a widespread, widely used vaccine until next year. So we've got ourselves, maybe a pretty cold winter for stocks coming up right now. And, I also feel bad for the restaurateurs. You see them, all these restaurants with outdoor dining, but it's getting cold outside. I don't know how much longer restaurants are going to be able to see people outside when it's like 50 degrees and windy outside. I don't think dining outside is going to be all that much fun. So that's what's going on. There's one other thing that I want to bring up, and then I'm going to let you go. Okay, so far we have no stimulus. That's the main reason why the market's down. The banks add to that. The down bank stocks add to that. So those are the two reasons why we would have had a down day because of no stimulus, I think. But the bank stocks being down just added insult to injury, and that's what made it a really bad day today. All right. And the last thing is Joe Biden, candidate or VP Biden, he floated his capital gains tax, which would raise capital gains taxes, like just off the top of my head, to about 39.6%, or just whatever the income level is for high earners. It doesn't apply to everybody. It applies to people with $1 million in income or more. Most stocks today are not held by individual investors. About 75% of all stocks are held by mutual funds, index funds, ETFs, pension funds, that sort of thing. So I don't think it causes a disaster, because the last two times capital gains taxes went up, stocks went down, but they only went down briefly. It was a very brief time, and then they went right back up. This one is much bigger than the last two capital gains tax increases, but it seems like it affects a lot. It's not a blanket wholesale thing, and it certainly isn't going to matter if all your money's in an IRA or a 401k, because one day when you take that tax deferred money out, you will have to pay taxes, whatever your income tax rate is. Okay, so that's the deal today. That's why the market was down. I think we could see maybe a little bit of a bounce back, but I don't think we have a sustained bounce back because we don't have stimulus. When could we get stimulus? Maybe the end of November. I mean, once you get into Thanksgiving and then holiday recess for Congress, and then you have to wait. No one's going to do anything in January. The next administration comes in January 20th. So basically, there's nothing going on in Congress until probably February. So that's why this could be so painful. And that's what investors are really worried about, that we could go through, 3 or 4 months of no activity on a stimulus bill. In the meantime, it's in North America, it's getting cold, and COVID is spreading all over Europe. And we expect that'll happen. We expect that'll happen in the United States too. Sorry to be on the negative side. There are some things to be positive about. This doesn't change anything for the way I manage my clients' investments. My clients have portfolios that are right for them in terms of their risk tolerance, their time horizon, their goals, so they can stick with them and not be forced or panicked out of their investments. And if you're investing and you're just starting out and you're accumulating assets, don't let somebody tell you that you shouldn't be investing, every month or every other week into your 401k plan or something like that because of a change in presidency or maybe a possible change. Don't stop doing what you're doing. The idea is to invest through thick and thin over 10, 20, 30 years, and that's how you make your money. In fact, more money is made by investing regularly during the down markets than the up markets, because if you're young, we said this, if you're young, a down market is your best friend. If you're older, just about retired or in retirement, a down market is not necessarily a bad thing for you, because presumably you don't have all of your money in stocks anyway, and maybe you could add a little into stocks when you rebalance, maybe reinvest some dividends, etc. So there's a lot of upside to a volatile or a down market, but I think you're going to be scared by the headlines. So I just want to give you an update so you're not scared by the headlines. Okay, we're going to end this broadcast. I thank you all for watching. I really enjoy doing this, and I hope you get value out of it. And I'll speak with you tomorrow at 4:30. Take care.